The European Union has finally reached a consensus on the price at which to cap Russian oil, which made it possible to avoid a full-fledged embargo. More specifically, the agreement states that it's still impossible to supply oil from Russia to Europe by sea. At the same time, the European Union decision allows European insurance companies to insure tanker shipments and transport firms to provide oil transportation services. Now, investors have taken a wait-and-see approach in anticipation of a response from Russia. According to Russian Deputy Prime Minister Alexander Novak, the government is currently working on a mechanism to ban the application of the price cap on Russian oil, so the market is standing still waiting for Russia's retaliatory measures. OPEC Plus, in its turn, decided to stick to its oil output targets. Apparently, oil producers expect Russia to reduce its own production and impose a ban on the supplies to those countries that have joined the price cap. After all, Moscow has repeatedly warned of such a scenario. Thus, oil prices will most likely remain relatively stable until this issue is resolved. According to the trading chart, Brent crude oil slowed down to the pace of its upward cycle around the resistance level of $90 per barrel. As a result, the quote entered a phased correction, thus losing about 4.5%. The $85 mark is now seen as a variable support level, at which the volume of short positions has decreased. Thus, the benchmark will resume its slide only after the price fixes below 85 on the 4-hour chart. Until then, it will keep trading sideways. As expected, the European Union decision led to a weaker ruble. This is, in turn, allowed the dollar to rise to 62 rubles. Moreover, the Russian currency will most likely continue losing ground until Moscow announces retaliatory measures. Given that the Russian government is in no hurry to take action, some clarity will come only by the end of this week. Thus, the dollar will have enough time to advance to 65 rubles per dollar. Gold seems to have settled around $1,800 per troy ounce. However, despite a further decline in the dollar, the yellow metal failed to rise above that area. This indicates that gold is overbought. Over the past months, it has gained more than $100 with almost no pullbacks. That is, as soon as the dollar enters a correction, gold may well post heavy losses. The only question is when exactly this will happen. From a technical point of view, gold added almost 3.5% as a result of its strong upside momentum gained last week. The asset will continue its bullish run after the price consolidates above the $1,810 mark on the daily chart. And this move could even change the medium-term outlook. Until then, the most likely scenario suggests a return below the level of 1,800. Fundamental analysis experts are confident that much will depend on the European Central Bank. At the end of the last week, ECB members hinted at a possible slowdown in the pace of interest rate hikes. If these assumptions are confirmed, the currency market will tumble into correctional territory, thus dragging gold prices down. And that's all for now. We wish you profitable deals. See you on our channel with a new video in a couple of hours.